Hi, Shachi.
Hello, can you hear me?
Yes, we can hear you.
Okay, great. I'm just gonna go ahead and set my background.
Mhm. Perfect.
Yes.
We've got about 4 minutes to start for a start
Okay.
time. You're ready with the presentation in the presentation mode?
Yes, I am.
Perfect. The audience can see us now, so we can begin.
Okay,
So,
great.
a very warm welcome to all the registered participants and everyone who's looking at us after the main webinar on 17th of December. So, welcome again. We had a very innovation driven, technical plus business oriented session recently, just 10 minutes ago, from Suresh Baisani, who's the director of engineering from Eightfold. And after that session, we had very interesting question that was answered live. This is one of the key factor of attending a live webinar, to get your pressing questions answered. Our next session is from another tech guru, a fintech guru to be specific, Shachi Sayata, who's the vice president for Barclays Bank. She's joining us here today. Welcome, Shachi, to this webinar, to this live webinar.
Thank you very much. I really appreciate the warm welcome. Thank you everyone for joining and taking time out for this presentation. My name is Shachi. I am a vice president at Barclays Bank. I also serve on the Bretton Woods Committee, which is a nonprofit organization which is focused on providing policy recommendation to international financial institutions. I am an engineer by my education, but my love for economics and financial services has brought me the career that I have today. I'm very grateful for all the opportunities that have come my way, and I'm hopeful to break down some of the digital transformations that we're going to see in the coming years. I think this presentation is very timely, considering the geopolitical landscape that we're in right now. We obviously have a new president coming into the office in the United States, and there are various movements in Europe as well. So keeping these things in mind, I think this event is very well timed, and I'm grateful to be walking you through some of the key developments in digital transformation and financial services. So before we do all the fun stuff, just a standard disclaimer. The views and opinions expressed in this presentation are my own, and they don't reflect the views of my current employer or my prior employers. The presentation is primarily for your information purposes only. I'm happy to answer any questions to the best of my capabilities. Getting into the digital transformation in financial services, I think this is a very exciting topic, primarily because financial services is an industry, unlike many, that has a global impact. It impacts our daily lives in terms of whether you're buying a house, buying a car. If you have a startup, it impacts, are you going to get funding? What does that funding look like? The key drivers for transformation in this industry, as you can expect, are driven by customer expectations. When we think of customers, these are not just retail customers. Regulators play a very key role when it comes to customer expectations. So the Federal Reserve, the SEC, as much as we may not like, they are also our customers. So meeting their expectations is a key driver as well. AI advancements, as we saw in the previous presentation as well, there's some key advancements in the area of AI, machine learning, which also impact financial services, and data analytics, which has been used heavily when it comes to algorithmic trading, which we will cover in the following slides. Where my passion really lies is risk management. I've worked on developing risk models for credit default swaps, which were one of the primary drivers of the '08 financial crisis. And I also work right now in my capacity at Barclays developing risk models for multi-asset derivatives. The role of risk management is really to prepare for unforeseen disruptions. A language that we use in our industry to term these is called black swan events. So these events account for tail risk. They don't occur very often, but as risk managers, our job is to sort of quantify the probability of occurrence. Some key case studies when it comes to risk management is the 2008 financial crisis. A more recent one is the COVID-19 impact on the financial models. Most of these would have touched your daily lives as well. Like I said before, this industry is very interesting because it impacts on a global scale, and you can see the ripple effects. Nothing works in isolation here, which is what makes things very interesting. One of the topics that I wanted to cover is the role of robo-advisors and how these will transform the financial services landscape. Robo-advisors are nothing but automated platforms that offer financial advice similar to traditional portfolio advisors. Robo-advisory services in the US, we currently just have 2 trillion USD asset under management compared to 40 trillion, which is managed by traditional advisors. The reason I mentioned this is because in the coming years, there's definitely going to be a rise in the robo-advisory services that will be offered. As you can see, there's quite a large market that needs to be captured there. So with the advancement of AI and the sophisticated models that we're seeing now, I do see this sector expanding in the coming years. Why are robo-advisors a interesting proposition for us? It's primarily because of the cost effectiveness and the accessibility. You could be sitting at home, you could be at a beach, you could open up an app on your phone, enter your financial goals, and the robo-advisor will shoot out a plan for you that is customized for your needs. It offers personalized advice through algorithms, and it scales a large set of solutions. So it essentially takes away the guesswork out of your financial needs and make sure that you're receiving the advice that's tailor-made for you. With every benefit, there is a risk, as we like to call it. There is an over-reliance and dependence on simplicity of these models, which is why we have not seen a lot of people flocking from traditional advisory service straight away to robo-advisors. Like I said before, this is still an industry that's being developed, but I'm excited to see the new advancements in the coming years. So just to throw some numbers out there and give you an idea of how robo-advisors perform when compared to your traditional S&P 500 ETF. Here I've taken an example of Betterment, which is one of the more popular robo-advisors, and I've compared it to S&P 500 ETF. As you can see from this chart, which goes from 2018 through 2023, robo-advisors, which is Betterment in this case, does not perform better than the S&P 500 ETF. This is primarily because the market that we're in is bullish right now. We are tracking the S&P 500 ETF. As you can see, the chart is tracking the ETF pretty closely. There is a steep learning curve when it comes to these robo-advisors, but the goal of a robo-advisor is not a get-rich-quick scheme. It's more of a long-term investment. It takes into view your personal financial goals. It takes into view the risk tolerance that you have. So it may not be as risky. It's more for long-term investment purposes. Again, with the advancement of AI and data analysis tools, also better machine learning algorithms developed by these robo-advisors, I wouldn't be surprised if in the coming years, this chart looks completely opposite as it does right now. A second thing that I do want to speak about, which I get asked a lot, is sentiment analysis. This is nothing but just having your models use market sentiment, social media, news articles, reports to trade. So one example of this is, let's say Elon Musk has a tweet, or the Federal Reserve sends out a news about cutting interest rates. How does that impact market movements? How does that impact a stock price? This is what we call sentiment analysis. It can be used in various ways. One way is to predict market movements. So the correlation between Elon Musk's tweet and the Tesla stock price is a correlation between the market movement of Tesla's stock price. It can be used for risk assessment. So for example, who gets picked on Trump's cabinet would be a good source to assess the risk. It is also used to identify investment opportunities. If any of you have been following the news right now, you must have seen the surge in Bitcoin prices, which is primarily driven by the new president-elect's pick for his cabinet and his belief in Bitcoin, which is something that can be termed as investment opportunities identified because of political events. There are experts, one of them who is Nassim Taleb, who challenges this view. I've read a few of his research papers that highlight the complexity of our financial systems, and his view is primarily correlation is not causation. So the view that we're presenting right now is quite simplified, and it can be prone to a risky downside. One of the other examples that I wanted to cover as part of sentiment analysis is the recent surge in GameStop's stock price in 2021. The stock price of GameStop surged by 1,600% within weeks. This was driven by a Reddit community called Wall Street Bets. As you can see on the chart of the right, it started pretty flat in January, and then there was a tweet by Elon Musk in January, which caused the stock price to surge. This is something that is obviously unique. We've not seen this before. It exposed some vulnerabilities in our financial system. It highlighted the power of social media and how social media can be used to drive market movements. There were a lot of lessons learned from this for both banks and institutions. It highlighted the power of retail investors, and it was something that was quite interesting to observe from a risk management perspective. The third item that I wanted to explore in this presentation was algorithmic trading strategies. This is something that has been in the industry for quite some time now, but over the last couple of years, we have seen some more sophisticated models come into play. Think about this as stress testing, your back testing. You develop your strategies, you use your data mining tools to understand how these strategies would perform under various market conditions. You can use these strategies to arbitrage, momentum trading. A lot of option trading strategies are based on the same principles. We will see a rise in more complex algorithmic trading strategies in the coming years. To give you an idea of where we are today, the size of the algorithmic trading desk in the US, about 60 to 70% of the equity trading volume that we have right now is from algorithmic trading accounts. There's not much traditional long-term investment that has been going on right now. Median desk size is about 500 million to 1 billion. These desks are pretty large. They trade huge volumes, and they're sitting on a large amount of data, which is primarily what we call tick data, which essentially means that you're getting every single tick from the stock exchange to make sure you're capturing the price movements. Two examples in this, Citadel Securities, which is the leading algorithmic trading desk unit. They have multi-billion-dollar assets under management. And another one is Renaissance Technology, which is a quant-driven hedge fund, which just means that they employ a lot of math majors, a lot of statisticians to come up with these trading strategies, and then essentially sit on large sets of data and execute these strategies. One of the things that I wanted to cover in this presentation is what happens when things go wrong. As we all understand, when things go right and you have an upward trajectory, it's all great. But it's very important to, as a risk manager especially, to understand what happens when things go wrong. A specific example I have here is what happened in 2012, which is called the London Whale Trading Day. There were a few trades that were made by a group of traders from JP Morgan, which resulted in a loss of 6.2 billion in derivative strategies. They essentially had over-reliance on these statistical models and algorithmic trading strategies that we reviewed on the previous slide. There were also poor risk controls that were set up in the bank, which have since then been fixed, obviously. But it just highlights the need for robust oversight, stress testing, and adjusting those trail risks. This also highlights the need for regulators to understand where the advancements in the financial services industries are going so that they can better regulate these industries. As you can imagine, 6.2 billion is quite a huge loss. And it's something that needs to be looked at very closely. So to give you a timeline of what happened, in January of 2012, we saw the bank increase its derivative trading desk. This was primarily CDS trades that were on what we call the investment grade index. By March, we saw that these losses increase and the bank orders trading stopped. By April, there was interestingly a report by the Wall Street Journal, and they call these trades the London Whale. No one took these reports quite seriously in April, and it was in July that we saw these losses hit the books. So there was 5.8 billion in July, and then eventually it amounted to 6.2 billion. Since then, there have been a lot of controls placed, but this just goes to show a simple trading strategy that could result in huge losses. I also wanted to cover some of the challenges that we do face in digital transformation. As you can imagine, financial services is like a very heavily regulated industry. It's quite hard to do changes, primarily because the impact can be widespread. It's important to understand this because not just as a retail investor, but also as a global financial system, any changes that we do in the system can have a global impact. One of the key aspects is data privacy and security. For us to develop these models and sort of do all the back testing and stress testing that we have, we need to ensure that the data privacy and security standards are met. They're in compliance with regulations. There is high regulatory oversight as to what is the data that we use for stress testing, how did we secure that data, how did we compute those stress testing models. So the regulators are very heavily involved when we come up with our algorithms and our risk management frameworks. The second aspect is the technical complexity. There's huge technical complexity, unfortunately, because these financial institutions are quite old. They sit on a lot of legacy systems, a lot of legacy architecture. As you can imagine, some of these banks have been around for decades. They sit on some of the infrastructure that is not fit for purpose for these AI machine learning tools. So there's a significant cost associated with upgrading these legacy systems and integrating them with our new platform. This is just cost of doing business. It doesn't bring in new revenue and is something that increases our complexity, unfortunately. There is a risk of overfitting. While machine learning models are great at analyzing past data and predicting unprecedented events, they don't account for some of the tail risks or the black swan events that we talked about earlier. There's a very interesting book written by Nassim Taleb, which talks about the anti-fragility framework, where he said systems must grow stronger under stress, and the goal is to thrive because of the stress. His focus is not on resiliency or recovery management, but more on how can we ensure that our financial systems perform better and stronger under these stress situations, which is something that we should be working towards. Some future trends that we will see in the financial services landscape is AI advancements. There will be more sophisticated adaptive algorithms that will be used. This is already being developed by most of the banks right now, and it's only going to get bigger and better. Hyper-personalization and tailored services, robo-advisors is a great example of this. We will see these robo-advisors capture more market share in the coming years. Blockchain is huge, especially considering its security and transparency standards, as well as cryptocurrencies. And the anti-fragile systems designed for resilience and volatile markets, especially considering the geopolitical landscape that we are in today. There will be more focus on building anti-fragile systems. In conclusion, I am very passionate about the financial services industry, and I'm quite bullish about the digital transformations that we're going to see in the coming years. Technologies like robo-advisors, sentiment analysis, and algorithmic trading are key into driving the change here. And the key takeaway here really is that the success depends on innovation, but taking into account risk management principles. We don't want to get into a situation where we're overfitting our models. So that's something that's key and should be considered here. With that, I will conclude my presentation, and I'm happy to take on any questions.
Excellent presentation, Sachi. I think we have touched very important points and given us some excellent insights and information, and the audience is more than happy. I'm sure they're more than happy. We have a question. I think this is something we discussed during our previous call. There's a question that could you please share some information about cryptocurrency and what we will see, what we will see AI, will we see AI models for crypto trading? Okay, okay, something different.
Yeah,
Yeah, go ahead.
absolutely. I'm happy to take this on. I think this is a very interesting time to be speaking about cryptocurrency, especially taking into account who our next president is going to be, his view on cryptocurrencies, who he's picking for the cabinet. Um, as we can already see in the last couple of days, just the performance of how Bitcoin has done.
Mhm.
There are AI strategies that have already been developed and deployed for algorithmic trading strategies for cryptocurrencies. They're definitely on the rise, but it's one of those things that is still under view and under assessments. Banks have collateralized these, but it'll be interesting to see what the different hedge funds do. Um, Another topic I actually want to bring up here is just the stable coins and using these cryptocurrencies as a payment solution. So think about your credit cards right now being replaced by a cryptocurrency and using that as a retail person. That's also something that we could see in the coming years. Again, it depends on the administration and the rules that they put up, but it's definitely something that's exciting for us to see.
Interesting. Great answer in terms of so it all depends basically on policymakers and leaders who dictate the terms and what the individuals can do. A little bit inside, there's another question that I personally wanted to ask about advisory. Now, robo advisory is something which is like similar to agentic AI that we spoke about in our previous presentation, and this is something that every industry is trying to do, where create AI-based human-like agents who could answer questions with limited intervention from real humans or agents. So when it comes to trading platforms or when it comes to executing maybe a portfolio management for hedge fund managers, how can AI be swiftly used and with compliance in real world scenario?
I think where robo advisors are today, we see them being used to replace portfolio managers, but this is primarily done for like smaller retail portfolios, to replace your traditional investment bankers and your trading desks, to be more automated, just like robo advisors is something that has not happened just yet. It's primarily because of the complexity of these systems that we sit on, as well as how tightly knit the financial services industry is. And if you think about it, if today I told you that, oh, Bank X was replacing 400 traders with an AI model, I'm not sure how comfortable you would be um, knowing that. So, in simple words, I don't think the industry is there yet. It doesn't mean that we won't get there, but unfortunately, in the financial services industry, you have to wait for other industries to implement some of these digital transformations fast. You have to see how they perform, and then you can adopt them in the financial services industry. This is not to say that we're not the driver of innovation. It's primarily, again, to ensure that risk tolerances are in place. The impact is just so huge that we prefer to let other people be the first movers, take lessons from them, and then adopt them.
Makes sense, of course. Security becomes paramount when it comes to financial services, and it's all about money. If your money is secure, you're secure. So, yeah, these decisions do impact, the policymakers' decisions or institutional decisions impact individuals when they have to use technology to manage their funds. Having said that, technology like blockchain now, which is existing, and a lot of inter-country transactions are using blockchain as a technology now. So if I have to, like, I'm talking as a layman, say someone who has no idea about how technology works. Say we have a blockchain and then layered AI on blockchain who is doing our trades, and it is only accessed by tokens assigned to that particular institution, his account, and that individual. Would that be a realistic scenario? Maybe in next year, 2, 5 years. I'm just a thought.
Yeah, that is a realistic scenario, and that is being deployed right now. A lot of banks do this again for retail customers. But think about it this way, right? Like the hedge funds that we see, they work in like multi-million, billion-dollar transactions. They work it every nanosecond. While cryptocurrencies are a significant part of their portfolio, we are seeing that they're still using traditional equity, FX, commodity type trades more. That's not to say that this won't change in the future, but trading equity is like the bread and butter of these hedge funds, at least for now. Maybe in the coming years it evolves, but we're not seeing this being used by investment banks at a more commercial scale.
Got it. Got it. I completely understand, and great answer. I think that covers the session for your presentation, or the topic of your presentation. Thank you so much for sharing that. And it was pleasure having you on board as an expert speaker, and your guidance and your knowledge has enlightened us all. We will join back again in next 15 minutes for a panel discussion. This will be a very informal session, so we'll have fun. We will talk to each other. We'll see. We'll share our inputs. I have some experience in various industries, talking to various leaders. So we will start with a general overview of digital transformation, and see what background we have come, and how we can help industry leaders understand each other's profile. So you will be there, Suresh will be there, and I'll be there. We'll have a great time in the next panel discussion. So I'll see you all in next 15 minutes. Please use the same link to rejoin again, and I'll see you guys on the other side. Thank you, Sachi.
Thank you.